What is going on, and welcome on into today's video. We are looking at the Robinhood portfolio, which I don't think I've pulled this up in a long time. So here we go. I've talked about it and pulled it up on live streams, but not in an individual video to talk about this. So I want to talk about the portfolio, what my thought process has been about this portfolio, how it's achieved 54% without trading. Now, there's been some trades here, but I'm really not trading it. I'm trying to be much more passive, passively involved in it, if you will. The plans going forward and how it's done compared to the S&P, which if you look at the S&P 500 right now, yeah, today's a big up day. Yeah, that's what made me think of this video, because I'm like, hey, the portfolio is up a lot. I should probably talk about how and what I've done and my thoughts going forward, and and things that I think I can improve upon, the downsides of it, and all that stuff. So from essentially the lows of end of last year to now, the S&P is up like 18%, 17-18%. And this portfolio is up about 54%. There have been more net withdrawals from here than there have been deposits. But that Robinhood doesn't really care about that. It'll just recalculate the return based off of, take the deposit out, withdrawal out, whatever. So it's not like, oh, if I just deposit more money, it'll increase this number. No, it will not. So overall, here's how I think of the portfolio. I think of the portfolio as this is the core. This fist is the core of the portfolio. And we have these fingers, these pieces. And these fingers and these pieces, they represent different sector exposure. But the core of the portfolio is not individual stocks, not an individual stock, I should say. It is a ETF, or a way to essentially get exposure to a lot of stocks. Okay, think of the S&P 500. In my case, it is an income ETF, but there are some downsides to that, which I'll get into, and we'll kind of talk about the plans going forward of how I want to optimize this portfolio and how I think I can optimize it even better. But then think about maybe a little bit of Bitcoin, maybe a little bit of silver, maybe a little bit of bonds, maybe a little bit of, an ETF, biotechs, because they're oversold. Funny thing is I can't, with my fingers, the other got kind of weird. I can't do the ring finger on this hand, well, both hands. I can't just put that up by itself. So when I do this, it's like I have to do the pinky first, and then the ring finger comes up last. And then let's say that, airline exposure, for an ETF. So it's not like I'm getting one stock and doing that, which was a strategy that I used to implement, and it could be really good, but it also can be really, really bad. And so the problem is that I shouldn't want to deal with the downside of that. And so when you buy an ETF, your downsides aren't going to be as big, and your upside's also not going to be as big, but you can sleep better at night. It's kind of how I view it. I'm not thinking about any earnings reports. I don't have to worry about an individual company. I don't have to worry about some stupid CEO doing something stupid. None of that, yeah, okay, a sector could take a pretty big hit, but realistically, the sector taking a pretty big hit is not going to, destroy me, right? The sector as a whole, okay, whatever, it is what it is. But that's kind of the core to what I've done. And as you look on the right-hand side, I'll pop myself off the screen. You can see that I have some pending orders. I've just thrown some, as I like to say, some lines out in the water to see if I can sell some covered calls. And then we have the positions. So if we dive into the positions, these are all option positions. This is you call it a calendar spread, I believe. So essentially, if you know the details behind this, I had bought this 455 2 weeks ago. I had sold for 15 cents. I sold a 445 for last week for 20 something cents. So I've already made money. And then I sold a 454 yesterday as well for a couple more cents. Either way, this is a calendar spread. So it's not I'm not buying SPY calls, you know what I mean? And then I don't do that anymore. I don't play options like that. I only sell them generally, or I do a spread like this, which is more of a test case. That's what I was doing. But then we have a Labu covered call here that we sold. That's worth 1 cent. That's pretty much worthless. We have a Jets call that we sold. That's actually got some value because I think Jets has gone up, but I'll talk about that in a second. A BITO call, covered call we sold. That's almost worthless. ARC, almost worthless there. Now today the market's up, so these are actually up a little bit. But the intention is that these are all going to expire worthless. This probably won't, but that's okay. Most of these will expire worthless, and I'll just cash flow the extra few bucks, which in that case is a dividend. It's like I'm paying myself an extra dividend by using covered calls to cash flow. That's what it is. So that's what that is. Now let's dive in deeper. Cryptocurrencies. We'll get into the next piece here. I do have Bitcoin. I do have some Bitcoin. That is that's the result of my sports betting run that I had earlier in 2023 when the football season started. I had like $50 in Bitcoin I threw into a betting account. I turned that into a couple $100. How much is in here now? Maybe more than a couple $100. No, about well, it's up. So I turned it into like 500-ish, and then Bitcoin's gone up since then. So now it's worth 750, which is kind of cool. But in the grand scheme, right, this is based off of the Bitcoin position is based off of sports betting that I had, and then I withdrew the money back to Bitcoin, and I was like, all right, I'll hold it here, and then I lost the rest of the money that was in my account, and I haven't bet since. So it's kind of a good way to do it. Like I have gotten into that in the past, and I've gone down a pretty dark hole. I went on a pretty good run. The run eventually ends, and when the run ends, I was like, all right, now I'll watch games just to watch games versus trying to bet on games. Kind of an interesting way to I put it. Essentially no ETH. That's just I couldn't sell the last bit for whatever reason, so it's like a couple cents worth. And then, you can see it. And then we get into the stocks. So if you look at this list of stocks, you'll say, oh, let's take a look. Let me screenshot it. Let's copy his stuff. No, the way that I want to go with this channel and stuff is these are not videos. This is not a video that is about, oh, buy these stocks, copy these. Like, no. This is more of, here's what I'm doing, okay? And this is what I'm up to, and these are ETFs. And here's how I work the strategy. So let's get into it. So really going down the list, we have ARK, which it's actually a recent addition to the portfolio. And if you notice that all of these except TLTW are in multiples of 100 shares. Now, some of them have more than 100 shares as we've had reinvestments of dividends and whatnot, but they're multiple. I buy them in multiples of 100 shares. And I do that for a reason, so I can sell covered calls against these positions, okay? Now, ARK is a recent addition. This is actually a position that I added or I bought recently because I'm like, hey, I have no growth exposure. I kind of want to get some growth stock exposure, and that's why I got it. And ARK is awesome. You can sell some good covered calls there, so it's a great cash flow machine, even though it doesn't pay a dividend, so you can make your own dividend. Labu is a recent way to get into the biotech sector. Now, that's a 3x ETF. That is risky, same as TMF. These are both riskier positions. Now, when I say riskier positions, these 3x ETFs are not as risky as options in my opinion, but if we go down, they can take a pretty big beating. So I don't go in massively onto these. TMF actually is a little bit larger because I had some puts that I sold that all got filled in the past couple of weeks, but now we're up nicely on it from those recent buys. But Labu, for example, XBI, like if I look at the biotech ETF, XBI, you'll notice that XBI currently goes for $70, okay? So that's going to be pretty hefty to get 100 shares. It's not going to be cheap. Whereas I can go and look at Labu and get 200 shares of Labu, be able to sell covered calls, get my exposure. And so I just size in smaller on a 3x ETF. But I do that, and I'll explain, the thought process there here in a second. JEPI is the core here. That's a dividend ETF, pays 10-ish% roughly dividends, pays you monthly. So it's a way to compound that faster and faster. Hence, I originally bought 100 shares here. I do have a recurring buy of $75 a month on JEPI. This is going to potentially change soon, and I'll talk about that in a second. SLV, my silver exposure, BITO, additional Bitcoin exposure. Now, this is kind of what I had prior to the betting, money. So, happy to get rid of this at some point. So I'm going to start being more aggressive with the covered calls that I sell, and it's up from when I bought it. TLTW is essentially a bond TLT exposure income ETF, just to get some extra value out of that. And then Jets is a recent buy as well. So that is the deal across the board on the positions. Now, you look at that and you say to yourself, that's kind of, if I looked at that 2 years ago, I'd be like, this guy's just boring, he's not trying to make money. And I'll be honest with you, I'm not. Like I'm if you go back to this year to date here, I'm not trying to do, like, this is not going to happen again next year, likely. Unless the market goes up a ton, then yeah, I guess it could. But the reality is that I'm trying to just cash flow a portfolio and build it over time. Now, the reality is as well, I keep saying the same words, I feel like, I personally I'm not adding money to this portfolio right now. I will. And you think to yourself, why aren't you? Like, this would be dumb not to. Yes, I will. But as of right now, I'm paying off student loans as fast and aggressively as I possibly can. So every extra cent is going towards that. Once that's done, which hopefully is soon, I also have, with rates and stuff. That's in my view. Yes, you can look at this and say, oh man, if you can do 54% per year, why would you pay a 6% loan? Like, I get it. But at the same time, like, kind of for my sanity, and I have only been operating this for like a year. So I don't know how this is going to do in a down market. Like, I would love to be able to go back and see how this would have done. I guess you can kind of back test in 2022. Yeah, it probably would have been down, but how much would it be down? How much would I be able to cash flow from it? Like, all of that would be interesting for me. But once that's taken care of, or at least those are in a better place to where either, let's say, rates come down, I refinance, or I get them down to a pretty nice number where it's like, I got that in the bank, I got it covered, it's no big deal, I can pay that off anytime. And now it's like, hey, I see more value with my money here. I can split that up and start putting more money here. But for now, this is what I do. So that's this literally 100% transparent of what's going on. I also utilize some margin. If you do the math and do the calculations, yeah, I'm using margin. Now, I've got buying power. I could technically use more margin, but I'm not going to. I don't want to go too deep on the margin. But when I do that, I feel like it's almost justified because it's not as risky as going on margin for SPY calls. You know what I mean? Or betting on the direction of the market. I don't really care what the market does. Now, of course, the market's up, so it's like, oh, cool, look at me making money. But again, this is just the portfolio's value and how I plan to like really rip this going forward. So that said, now you got an understanding as to how we work, or how things work, how we're positioned. Now, I will sell covered calls here, not every week. This is actually a pretty big piece. This is where it becomes subjective. This is where I think the game gets interesting, and where I would be open to more of a mathematical approach and more of kind of a little more systematic. But I do not like, for example, on, let's say, ARK. I recently sold a covered call on ARK, I believe last week or earlier this week, after it made a pretty big move. But when ARK was moving down, okay, I am not going to be selling covered calls really close to the money or just above where ARK is trading. Why? Because you have the risk of one of these rippers and then you get taken out. So I am being very strategic, and I'm not trying to sell covered calls very close to the money. So all my covered calls are in the 5, 10, 15, 20 cent range, generally speaking. So you think about that, it's like, that's kind of shit. Well, add that up across a couple ETFs, a couple times a month, plus the dividend ETFs, plus potential appreciation. And it starts to get interesting where you can start to give yourself and pay yourself a couple percent per year through just covered calls, and that are like very, I don't want to say very safe, but pretty low risk covered calls that are not, really a huge threat for you to get taken out. Now, hey, it can happen and it will happen, but the way I like to view it is like, hey, if we got to this price by this date, we would be very overextended. I would be okay with letting it take me out, and then I could sell puts to get back in if I want to get back in, or I can just let that thing play out and then rotate into something else. So what I do is on those fingers, I tend to sell the covered calls on those fingers. And as these fingers come back to like the mean, if you will, I am likely to exit them. So the core is something like JEPI, something like an S&P ETF, where you have total market exposure, you're selling covered calls, or it's a dividend ETF where they're paying you higher dividends. And then from there, these fingers are just different exposures. And so what I viewed it as, if I zoom out on the weekly chart, I viewed it as, hey, I don't have exposure to growth. The ETFs that I currently hold are heavily underweight growth stocks. This is all growth stocks. Let me get exposure to that. And guess what? It's pretty oversold down here on the weekly time frame. We're not trading this off of like, hey, it's down a little bit past couple of days. No. weekly time frame. We're talking about like I'm fine holding these things for months to years. Is the idea. There tends to be more volatility in the year than sometimes you think, and so that offers more kind of in and out, but not a ton. Same thing with Jets, right? Jets ETF massively oversold just the past couple of weeks alone. So that's when I actually bought it at $14.91, I believe is my average, which is like right here. And as the thing comes back up towards the mean, if you will, or towards where the middle of where it was trading prior, there's no, like, if Jets gets up to here, obviously it could go up more, yeah. But my core return was the bounce back and buying the oversold, buying a sector when no one wants to and everyone's selling it. And if I'm selling covered calls, I mean, I could pay myself, 10%, 20, 30% in a couple of weeks, a couple months, maybe a year for holding something like this. You know what I mean? With the appreciation plus the covered calls. In my case with Jets right now, I sold a 2-week out covered call for 16, and now it's at 16.24. I may get taken out, but for a 2-week long hold, let's think about this, from an average of, I believe it was 14.91. So let's go right there roughly to, let's say, $16 where my covered call will take me out, is approximately 7.3% plus what I sold the covered call for. So let's say 7 to 8% return in 2 weeks. That's almost what the overall market returns on average every year in 2 weeks. So I'm okay with something like that happening, because if that happens that fast, all right, I'm happy to lock the gains in. We can reassess and talk about this again, another day, or look for a different sector. Although, it would have been nice to be able to capture, a move back up to 18, 19. Yeah, okay. Perfect world. Doesn't always work out that way. And then now I made some money and I hold the cash, or I can take the funds from that and then just roll them back into the S&P dividend ETF, income ETF. So we get through all this, and it's kind of the same thing, rinse and repeat. When a sector is very oversold relative to the market, I get interested, as in that's a sector that if you're betting on the U.S. markets in the long run, decades down the road, I could certainly see, there could be the negative return, right, for a decade. There could be the nothing decade where we just kind of flatline for a while. It could happen, but again, in doing so, you're selling covered calls, and you still get these returns back to the mean. So you're looking for the oversold stuff. That's what I would look for, and then I buy the ETF in that sector. And another one is XBI. So Labu is the 3X ETF here. I just size accordingly and only bought 200 shares instead of buying more, which would be like a normal size position or a larger position for the portfolio. But this got very oversold. I mean, look at XBI. It got very oversold, and we can even go to the weekly time frame. XBI got down to a level that it hasn't seen, that it's seen only a couple times since 2019. And every time it gets down here since 2018, it's bounced back nicely. And so it's the same approach. Like, oversold, okay, we start thinking about buying it. We can sell puts to get in. Those puts may fill, they may not fill. If they do fill, great. I mean, they execute, we get in, and then we look for a return to mean. XBI, guess what? XBI gets back up to $80. You can pretty much kiss my Labu goodbye. I'm not going to be holding that anymore. And because I don't care. I don't care about it going to here. I don't care. I really don't. Only thing I care about is being in the S&P ETF, so I have exposure to the S&P 500. I sell covered calls, so I cash flow. Ideally, I would get a dividend from the S&P position. Could be an income position or whatnot. And then I just rinse and repeat with buying into these oversold sectors, selling covered calls until they return to the mean. Boom. Now, the downside, XBI does this, right? XBI could. And hey, it could. It totally could. My rationale or my thought process here is, if it happens, so be it. I would still rather be buying the weaker or the more oversold sectors of the market anyway than buying SMH, which is the semiconductor sector, which, yes, if the market's strong, this is going to do well, and it's doing well right now. but I'd still rather buy the oversold sectors than buy this in a portfolio that I am holding long. I do not care about the timing. I'm not in long options with an expiration. I sell options to cash flow it. And hey, if it wants to flatline for 6 months, for 6 years, and for that 6 years, before it ever comes back to my entry price, which I'm still getting a dip buy entry price, which I believe is a much better way for a longer term investment approach than to be buying breaks to the upside. That's what I would do for trading, not for investing. I'm still selling covered calls. So if it takes 6 years for the S&P or for whatever sector to come back to where it was, which is possible, over that span of 6 years, I have probably cash flowed 10, 15, 20, maybe more % on the position for my portfolio. So it's built me some cash flow, and then it gets back to break even. Maybe it goes green eventually. Great. Over the course of that span of time, I'm still going to net cash flow from it. So I think of each of these holdings as like a mini little apartment or a mini little house that you're renting out. But it's a way that you can do this with less money, less time, and less stress than if you were to have real estate. Now, of course, there's other tax advantages and whatever, sure. But that's kind of my approach. Now, so we talk about some of the downsides there. Yeah, that's the case. But again, in a down year, despite the portfolio value probably coming down, what am I doing? I'm cash flowing. So then I'm going to have more cash built up on the sidelines that I can then deploy into more oversold sectors or sectors, or into a dividend ETF to sell more covered calls on and to keep the cash flow or to grow the cash flow even larger, right? So you cash flow the most in a trending up market or in a flat market from these covered calls, but it still could work in a down market in the way I view it. Now, downsides. When looking at these dividend or these income ETFs, the problem is that on the ex-dividend date, everyone loads in, the stock or the ETF drops the next day by the proportion of the dividend. So you end up in many of these just trading space and not moving very, very much, which is the problem that I have. So what I found is that when you look at all these income ETFs, they're not really worth it if you know what you're doing. So what I would say is something like, in the grand scheme, just buying SPY. Now that's expensive because SPY is $400, but there's other ETFs that get you the exposure that are cheaper. But buying SPY is, or just buying the source and then you selling the covered calls yourself versus buying into a fund that does that for you, is going to be substantially better because you're not paying fees and whatever. You just do it yourself. Now, you got to kind of know what you're doing. So you got to understand covered calls, understand a bunch of things. But that's what I would say is the route that I want to go. So we're probably going to move out of something like JEPI at some point and look for another ETF that potentially is similar, but that allows us more upside in selling our own covered calls, if you will. So that's the plan. Now, do you hedge? Yes, I do hedge. That's the last piece I want to get into. I do hedge this, but there are criteria that have to be met. So how would I hedge? When would I hedge? I would hedge when the S&P is overextended. So I'm looking at the S&P right now. Is it very overextended? It's getting there. Big move, right? It's getting there. If we were to break over these highs, maybe we can start thinking about hedging. But you have to have a couple of criteria met. The S&P needs to be overextended on the daily and ideally the weekly time frame. Okay. We also need to have the AAII sentiment survey. So what I look at being exceptionally bullish and very low bearish, which we, for a couple weeks in a row, ideally would be perfect. That's what I want to see. And then you got to go to fear and greed. Go to the fear and greed index. This needs to be at least greed. I would ideally want to see extreme greed. So if you have extreme greed, you have AAII that's been very bullish, and you have an overextended market, that is the only scenario in which I would hedge. And when I would hedge, I would buy something like SQQQ, or short the S&P instead of buying puts. You could buy puts, but then that puts a time expiration on it. So I prefer to buy the shares, and I would look at something like SQQQ as a way to hedge it. So this goes up and the market goes down. When QQQ goes down, this goes up by 3x roughly. So in a nutshell, that's it. Now there's not a lot of this. There's not many times this happens. Maybe it's a once or twice a year thing. Maybe it's not going to happen in a year. That is how I do it. And then how do you hedge on the other way? Well, if the opposite's happening and we're extremely fearful, we are extremely bearish, 50+%, and the S&P is very oversold, that's when I would be like, I'm okay dipping a little bit deeper into margin and looking for, another ETF or another sector that's very oversold compared to the S&P. For example, like how biotechs were, like how airlines were recently, and adding that to the portfolio. So it's like, it's kind of like this, you're riding these waves of the market to a degree, but a lot of the time you're kind of in between, right? And so when you're in between, there's not much to do. You just leave everything, you sell covered calls when, each week or each month, and that's it. So from a big picture perspective, I really like how this has been working. I cannot wait to be adding more money to it, more funds. Like I said before, right? Other priorities right now, that will change as time goes on, as life goes on, right? That will change. And the game plan, the goal, and the way I view it is, we can get this portfolio up to 100K plus 200K in the coming, years. Now, of course, appreciation helps, right? Cash flow helps, but really, how do you get there? You gotta be investing your own money. So I gotta increase my investment in here, which will be happening soon. And I think I can start depositing a lot of money into here once those loans are done, and it's gonna feel really good to do so. But that'll come when the time comes. And then when that happens, now you can do the math on. Now, obviously, 50% is nuts, and that won't happen when the portfolio is larger and larger and larger. When I'm a little more conservative, most likely, but if you can cash flow 10% on a 100K portfolio, it's 10K. That could pay for some things, right? So it becomes more meaningful as you get up there, and more maybe. So that is the update on this, and it's a long ass video, but that is a complete update, deep dive into how we've been able to do this, but also safely, if you will, and the mindset of doing this going forward. So curious thoughts, comments, leave them below. I'll leave some other resources. There's a bunch of sales coming up for a lot of the links and resources that we have in the video description box. Black Friday time, if you're looking for anything, the best deals will be soon. So thanks so much. I'll see you guys in the next one. Peace.